All right, I think we are live. Ladies and gents, we are live. Microphone should be working. I can see the little meter going up and down. I can see my face distracting me in there, and I can see the screen. So we should be good. The technology should be on point today. And I think we've got had a good run with this. We had a problem with the mic, didn't we? A month ago now, but we're all sorted. Okay, so we'll get started in a few moments. Let's have a look. Markets ramping up. The EU negotiations going well, supposedly. Let's see what happens there. We are almost back to on the NQ and Nasdaq. In fact, I'm lagging a little bit, but if you look at the Nasdaq's almost back to the Moody's downgrade level. That's a big key level to watch because we've kind of sold off since then. But we can seem to be reclaiming that. And actually, when you look at kind of all the gaps that we've had, we had a China news gap up, EU gap down. He moved the goalpost from June to July, and then we've had a gap back up. That's the US equities. Bit of a rally on dollar yen today. Obviously, gold selling off. Yeah, interesting. Let's see how the rest of the week plays out. Well, the end of the month, don't forget, got some data coming out. Lots to keep us on our toes, boys and girls, ladies and gents. I've been navigating these waters well. Hope you're managing your risk. Hope you're making the right decisions at the right moment. We're going to cover the risk block method today, and I'll say get started in a couple of minutes. Want to remind you that I have a podcast. Some of you don't even know this. And I interviewed Dr. Brett Steenbarger a couple of episodes ago. It's by far, I'm checking the stats here on my other screen. It's by far the most popular episode at the moment. Oh, by the way, podcast called Traders Mastermind. You can go and check that out it goes to all of the podcast platforms. That's the most popular episode I've done, which was super exciting and super enjoyable, actually. He's a bit of a hero of mine, as I said at the beginning. I was like, I used to read your blog back in 2004 when you first started. I'd only been a trader for a few years, blah, blah. The second most popular episode, if you're interested, is theme park economics. And this is when I kind of thought about I don't know about you, right? When you're out about, you're thinking about trading, you're thinking about business, that's just how we're wired. I think that's just the way we are as traders specifically. And, you think about theme park business models, like, they really struggle in the winter. Anyway, I go through all that and I use that as a parallel with trading, how theme parks survive and how to kind of that blends in with the thinking of trading and kind of getting rid of some of the dead weight, getting rid of the stuff that's not working, looking at your strategies and setups, etc., and trying to find out how you can prune stuff off to make the business model work. So yeah, interesting. I thought it was a kind of fun one. And the good thing about doing your own podcast is I do a bit of a mix. Chat with traders. Well, that's a podcast in itself. It's a great podcast those guys do. I chat with traders. I have a chatted conversation with traders, developing traders, and solo episodes. So enough about me plugging the podcast. Have you guys seen this thing? I'm maybe fiddling around with this. You can see this, maybe not. This is a little bar of silver bullion that I bought many years ago, and actually you can see the twin towers on it. So it's a long time ago I bought this. A trader friend of mine I used to chat to on Skype. I wonder how he's doing these days. Actually, he's a good guy. He was, super successful trader, great trader, and he was buying like a load of these silver bullion. And he said, "Do you want some?" And I said, "Oh yeah, I'll have one." So I bought one many years ago, and it still sits on my desk. Actually, sometimes sits on my bookcase behind me. So quite a cool reminder of trading journey. Anyway, let's get on to. No one cares about that sort of stuff. Let's get back to business, ladies and gentlemen. Thank you for joining me. Okay, today we are talking about the risk block method. A lovely quote there from Mr. Jesse Livermore. Absolutely thoroughly recommend his book if you haven't read it. I know you probably have, but Reminiscence of a Stock Operator is a must. If I was running a trading firm, I'd be like, here's this book. Do not do a thing until you finish this book. And actually, you know what? Maybe even Tom Hugard's book, Best Loser Wins, would creep in there. Anyway, great quote here. The desire for constant action is a major reason for failure. And I'll just pause on that for a split second because I think it's still apt right now. In fact, I know it's still applicable right now. How many traders? Listen, guys, we all fall into this bloody trap, don't we? Like we see stuff, we want to get involved, we want to trade because if we trade, it means we've got an opportunity to make money. If we make money, we feel good, the equity curve boosts up. But it really is a game of being precise, being cautious about how you trade, and just thinking about trading differently from the mob. And actually, that's kind of what we're going to talk about today. And I guess that's why you're here, right? These are unusual titles. We're not talking about moving average crossovers. We're not talking about how to trade breakouts, or any of the kind of vanilla stuff that's out there. There's nothing wrong with that. That's fine. But I think my objective with these webinars, having traded for over a couple of decades and having seen many traders along the way and knowing many super successful traders and traders who did well and then fall by the wayside, traders who are just awful from day one. I think that you and I, or you specifically, want to think differently to the mob, to the crowd, because we know the results the crowd get. We've seen it, we understand it, and the only way for us to move forward is to kind of really explore these different ways of thinking. And my objective with these webinars, as it has been, as it will be in the future, is always to share with you different ideas, different frameworks, different methodologies, different ways to look at stuff. Now, sure, there's always time-tested rules and laws, if you like, that will stand the test of time. Managing risk, all this type of stuff, momentum, volatility, expansion, contraction. We talked about some of that stuff last week. But I think sometimes we have to go a little bit deeper, a little bit more into the thick of things, so we can think differently, so we can have a different mental framework to the rest of the traders out there, so we can really make this work. So that's what we're talking about today, the risk block method. More on that in a moment, but I just want to, of course, we have to, if I can get the mouse in the right position, it's over there on my other screen. Of course it is. Quick risk disclaimer, ladies and gents. Of course, spread betting, CFDs, anything when you're trading with leverage, please be very, very careful. This is obviously in conjunction with Pepperstone. Pepperstone, regulated broker, CFDs, spread bets. Obviously, go and check them out if you're interested in looking for a new broker, switching brokers, all that type of stuff. We're kind enough to sponsor these, or in partnership with these webinars. So thanks to them, we've got the ability to kind of talk about whatever I want within reason, and anything stuff that I think is going to help you move the needle. But please be aware that it's super high risk, guys, trading, especially with leverage. Really, really great when things are working well. You're fully loaded up. You've got a big fat clip. Your margin is up to the hilt and the trade is going your favor. You're like, thank you very much. This is very nice. But it's a double-edged sword. It can work against you. Big position on, over leveraged, risk happens fast. And we have an emotional attachment to it. That's obviously another topic. But the long and short of it is, please ensure you understand the product that you're trading, the risks involved with trading. Only risk money you can afford to lose. And if you're unsure, get on a demo, play around with it, and just be 100% sure before you take the plunge. The ways we manage risk, and obviously we talk about risk management and stop losses and position size, all that type of stuff, we can never eliminate completely, but that's the business we're in, the game we're playing for the flip side of trying to get those asymmetrical risk reward trades that do very well for us. It's not always going to work out, but that's kind of the nature of the beast. So please be aware. I know what I say this all the time, but I do have a bit of a bee in my bonnet about making sure that everyone understands the risks. I hate to hear traders saying, I didn't really know how leverage worked and stuff, for new traders. And I recognize that you've probably been trading for many, many months and many, many years. So it's still worth remembering, isn't it? Okay. So quick reminder, I talked about this before. I've got some decent experience, but I'm never here to say, I know everything, listen to me. Yes, I've been trading for 25 years and I know every little thing about it, and look at all how well I've done. No, that's not my objective. My objective is to give you things that I believe are going to help you in trading, take things from other areas that I've seen other traders do, take things from areas that I've seen traders struggle with and flip on the head and say, hey, these guys really struggle with this. This is perhaps a better alternative. But as always, guys, anything you hear, listen, read, whether it's from some of the big guns out there who are producing great content online, or you jump on webinars or podcasts or whatever, always do your analysis, research, homework. Stuff sounds so good in the heat of the moment, but you need to go and say, hey, will it blend in with the way that I trade? Does it apply to my methodology? Does it apply to my lifestyle? Does it apply to my risk tolerance, the way that I like to operate? And don't be forced down a road and a path you don't want to go down. Don't be forced into trading a style that doesn't resonate with you. Be very firm with that. This isn't really the topic we're talking about today, but it's just trading in a nutshell is, hey, find something that works for you. You may not have found it yet. That's okay. But it's like, protect that with all your might, and kind of, don't get derailed and, oh, that looks interesting. Oh, look at this, look at this. Implement the change, stick to it, go through a process. And today's very much about that. This risk block approach is very much about chunking up ideas and methods and sticking to them and then adjusting as we go. More of that in a moment, but that's just something that I wanted to mention to you guys. Okay, so let's get down to the topic du jour. As always, if you're new here, you're very welcome. If you're returning, exceptionally welcome. You know how we operate. We talk for about 45 minutes. I tend to go over. I know my timing's not as good as it could be. I'm getting better. We'll do a Q&A at the end, and I'll make sure I get around to everyone's questions. And if I can help you, I absolutely will. If I can't, I'll direct you to someone. I think there's only one question that's caught me out so far. I couldn't remember who did the range bars. Someone asked me a question about range bars, and I couldn't remember who it was, and I still couldn't remember. And he emailed me, and I was like, "Mate, I'm sorry, I can't remember." Apart from that, I got a pretty good, I think, pretty good success rate of answering questions. Anyway, let's get on topic. So the problem we have with isolated trade thinking is this: is that I think many traders we look at the past. So you've got your trading blotter there, your journal. You see your calendar all laid out, or your spreadsheet, or it's on your blotter or your notepad or whatever it is, or even if you go and look at your broker statements. So we look at the past and we see these chunks and we say, oh, I did that month and that quarter. There's my equity curve for the year. There's my equity curve for the lifetime of the account, and we kind of look at that and we kind of look at it in a group, right? We don't look at each individual trade unless the last trade was very meaningful in terms of a lot of upside or a lot of downside. We look at it in kind of grouped up. But then when we look at it in the future, we tend to be so focused on the next trade. We never really future pace ourselves and say, okay, hang on, how am I going to look? How do I want this to look for the month, for the year, or for the quarter, sorry, for the year, or for the week, whatever it might be, for the day even. Like we tend to kind of only look at the outcome of an individual trade. And the problem with that is that we have this dichotomy of I'm looking at the past in a big group, if you like, in the future, my mind's thinking about, or your mind's thinking about this next trade, the next trade, the next trade. And now it should be, from an operational perspective, absolutely, right? The name of the game is to make a great trade. As Mike Bellafiore said in that, no, it's not that book. Mike Bellafiore, he did write that book, but he's written another one called One Good Trade. That's a great framework of like, okay, from an operational perspective, I want to make one good trade, one good trade, one good trade, just keep trading the next trade exceptionally well, stick to the process. Okay, fine. Let's take the operations and put them to one side for now. From a psychological perspective, if we are looking at each individual trade with so much focus and so much weight, staking our identity on the outcome of that trade, it really sets us up for failure. Because if we don't win that trade, we feel like we've not done the right thing. We feel like we've been let down. We feel like, I knew that was the one why didn't that work? I didn't have my ducks in a row and this was that. And it really increases the pressure. It can put you into tilt. And I think it can reduce edge because you're so focused on that trade being a winner. You're so focused on getting something out of that trade. You're not thinking the long game, like when we're looking backwards and we're looking at the blotter for the month and the quarter. When looking ahead, it's very difficult to then look for the week, the quarter, the month, whatever it might be, because you're so focused on that one thing. And it amplifies the emotions, it amplifies all the challenges that come. So what we want to try to do as traders who want to think differently from the crowd, from the mob, from everybody else, is to really not get so focused on the outcome of an individual trade. I know it's easier said than done, and we say it all the time, but this webinar, the idea of this is to give you a practical framework of doing that. So you hear it, don't focus on the outcome of individual trade, but you go, okay, fine, how? So hopefully this is going to share with you how to do that, or a way that I think is quite effective at doing this. So this is the risk block method. And the idea with this is that we program our brain to think in terms of trade sequences, not just single trades. Okay, and we're going to go into some depth here about how we define the block and how we group your trades, etc. It's not just going to be by risk, other stuff that we add in there as well. But the idea is that if you think about, I guess a good analogy is, if you think about a hedge fund manager, right? I know it's an overused cliche term, and we're not hedge fund managers, of course we're not, but they are concerned with the quarter performance. Maybe they're concerned with the month, but quarter is important. Why we have such a spike and such big movements in the markets at the beginning of the quarter, end of the quarter, right? Because people are interested in that performance. Sure, some are interested in the month, but generally speaking, it's the quarter. They're not so bothered about individual days, and they're thinking in terms of how's the quarter going to look? How's the quarter going to look, right? And for us, we don't tend to do that, but we should. And so the idea is that we group these trades into a predefined block, not necessarily a calendar like a week or a quarter, but saying, okay, this is a block of trades I'm going to do, I'm going to execute, and it might be a strategy, it might be a risk, it might be this, we'll talk about in a moment. But the idea is that I'm free to operate on each trade clearly, without pressure, without amplification of emotion, without all that stuff that can creep in and cause us to mismanage trades, jump into trades, pull the trigger too soon, get frustrated, get annoyed, go on tilt. It kind of takes the edge off those emotions, because once we get into that mentality of like, hey, this is one of many, and it's easy to say, oh, it's one of many in my career, but that's tough to think that far ahead. With the risk block method, we go, well, it's one of this. I've determined this. I've written it down. I know what I'm trying to do. And so one becomes less meaningful, and it becomes a case of just stick to the journey, stick to the process. I've got to get to this number. And it just helps really free you up to operate as a good discretionary trader rather than getting bogged down with emotion. Okay, so the idea of this is that if you think about we talk about the individual trades. Okay, so some of the benefits if we do operate block-based thinking, and I like to do this in very different ways myself. And again, I don't hear and say you should trade like me, and I know everything. Absolutely not, But I think that I've seen other traders do this, and I know other traders do this effectively in different ways. So I think it's something to explore. Lowers the pressure on individual trade outcomes. Talked about that. Helps absorb the natural losses and variance in your strategy. No one has 100% effective strategy apart from the trader on Instagram, of course. They've got 100% strategy for effective strategy. But in the real world, we know there's going to be losses. It's part of the game. And so it smooths that out in your mind. It smooths that out when you're kind of looking and reviewing your trade performance. And it really helps you think about, these logical points where you can actually make adjustments to your strategy, to your approach, the little tweaks, rather than if you're driving a car just looking down the front of the bonnet, you can drive, you'll be over the place, right? Like, the white line, the white line, this. You don't do that, you look ahead. But in trading, we can get sucked into kind of looking right down that bonnet and driving the car, one trade, make an adjustment. And we never get. It's a stressful way to drive, a stressful way to trade, and plus it's you obviously in danger of something going wrong. I'm overcorrecting. Oh, white line this side, you yank the wheel over there. Oh, the white line. You're going from pillar to post. And the same with trading. If you're so focused on that individual trade and not focusing on these risk blocks, you make these adjustments too soon. You end up kind of second guessing things when it's actually just a natural loss. You can have a great system, but it's going to lose. Stuff is going to just not work. And it's been accepting that. I was talking to a trader yesterday, you may be on the call, who had a real great point of, if I've got something that's got a 70% expectancy, or I expect it to be profitable 70% of the time, or 30% of the time it's not, then I'm going to take a trade that's just going to go down and stop me out. Or I'm going to miss a trade that's going to go in my direction. I'm going to see these trades, and I can't remember exactly the kind of context of it, but the point was there's going to be times when that even the really good strategy, I'm going to sit there and see that 30%. I'm going to be losing. I'm going to miss it. It's going to go my way in reverse. That is going to happen. So you're going to be stress tested. You're going to be put under pressure. And so using a risk block allows you to not worry so much about that pressure that's coming on you right now. The pressure of, oh, damn it, that thing's coming back to me. I've seen my unrealized P&L go. So no, it doesn't matter. And it's such a good unlock, I think. Okay, so back to the topic, defining a risk block. Let's talk about how we can think what these risk blocks are. So a risk block could be 5 to 10 trades risking 1R each, and it's just a genuine risk allocation. Good trader, good friend of mine, Scottish John, some of you guys know him. He talks about doing this. He does 10 trades, so he does 10R risk. And the reason he does this, he's been trading for, let's say, over a decade now. It's a long time. But his framework for this is very similar, and one of the contexts, and then we do it different ways. But his framework is to say, hey, listen, I don't want to think about the outcome of one trade. I want to think the outcome and not worry about where my P&L sits, where my equity curve sits. I want to do it after 10 trades. I know worst case scenario, I'm going to lose 10R. So let's say your R unit is £1,000. Worst case, if I lose all of those, is going to be down 10 grand. Now, he knows it's probably not going to happen, but if he's comfortable in his mind, he can just execute. And he's got a rough idea. Worst case scenario, am I happy with that? And by the way, substitute that R number for whatever suits you at the level you are now in trading, £10, 10 grand, it doesn't matter. But the point is that you then go, okay, if I'm thinking that I'm going to execute 10 trades correctly, I know my worst case scenario. It's probably not going to be that unless I 10 bad trades in a row possible, but I'm happy with that. I'm happy to accept that. No one's happy with losing 10R, but you get the idea. And after that point, I'll review and reflect. Now, he does it for a slightly different reason, I believe, which is that he doesn't want to worry about each individual trade outcome and the P&L and how much he's risking and stuff. So he thinks in chunks things up into these risk blocks. So that's one way you can do it. You can say, I'm going to risk XR, and I'm going to think in that sort of block, 5R, 10R, 15R, whatever it is, and I'm not going to worry about the performance or outcome of the individual trade. I'm only worried about the outcome of the block. That's the key thing to remember. Don't care about the outcome of the trade, as long as you stuck to your process, as long as you've done the things you're supposed to do. And sure, you're human, things are going to happen. You'll log any deviations, but you're not worried, shouldn't be worried about anything. You're concerned, or your objective is to review the performance of the block. Okay, so that's one example. Another example might be blocking them in terms of themes. So if you trade the opening range breakout, you might say, hey, I'm going to take 5 trades opening range breakout, or 10 trades, whatever it might be, and then I'm going to see the performance. I'm going to review the performance after 10. I'm going to not even get involved in it unless I've got 10 trades, 5 trades, whatever it is, on one specific strategy. Maybe it's an opening range breakout, maybe it's kind of a Wyckoff spring type trade, whatever it might be. It doesn't really matter, but the point is you're chunking them into a theme. It could be one market regime. Hey, when the ATR is above this, I like to scalp off exhaustion candles. Okay, or let's just define a risk block. And you might get other trades that come with it, by the way, and you can nest these together. You can say, hey, I'm going to have a risk block for the ORB breakout. Breakout twice? Opening range breakout. You know what ORB stands for. So opening range breakout. I might have actual just risk parameters, and I might have something else like a Wyckoff spring. And you might say, okay, I'm going to put risk blocks for each. But again, it helps you think long term, helps you future pace how your trading is going to go and not worry about the outcome of individual trades. So that's how you define a risk block. Okay, so now you start to take your trader head off and you put on your scientist head and you say, you know what? These are kind of experiments in a way. Now, there is an added advantage, I believe, that it helps you not worry about the outcome of the individual trade, all the other stuff that we talked about before. But one thing it can do is it can help you run a controlled experiment. And you can say to yourself, hey, here's what I'm testing. Here's how I'm going to execute it. Here's how long I'm going to trade it for. Here's the risk block. And I'm going to measure the results after this point in time. If you come to these webinars for any frequency, one of the very first things I put on the slide is, make an adjustment and stick to it. That's this. That's saying, you know what? I'm actually going to hold trades till the end of the day, or I'm going to hold trades for an extra hour, at least an hour, or whatever the parameter might be, or I'm going to add an extra clip into the trade when I get a 1 hour move. All these type of variations and things we could look at. You might be say, okay, well, that's a risk block. I'm going to do that for 10 trades. This is how I'm going to conduct it, and then I'm going to measure the performance. And similar to all the other things that we have looked at, it takes the pressure off being perfect. It puts that focus back on sticking to the process, and you say, okay, I'm going to do 10 like this, and maybe you slip up on one, right? Maybe you don't quite enter one on this. That's okay. You're a human being. You're a discretionary trader. You're allowed to make errors as long as they're not detrimental to trading and you're not going over the red lines like risk, etc. It's the real world, right? We live in the real world. We live in the trenches. Sometimes you don't pull the trigger on stuff. Sometimes you pull it a bit early. It doesn't matter. The point is that you're saying, okay, here's my experiment. I'm going to control it. And the point is you measure the results. And so a way to measure it is to say, okay, what are 3 things happened here? At the end of that block, 10 trades, whether it's a 10R risk, 10 trades, a specific strategy, or a specific market regime, or whatever it might be. Okay, that's good. I've conducted my 10 trades. I've risked my 10R. Now you sit down and you say, I'm going to review. And this is where you sit down, you're calm, market's not trading, you stick your noise cancelling headphones on, whatever it might be, and you go, right, now I'm in analytical mode. I'm not concerned about performance. I'm not concerned about the markets. I'm not concerned about making great trades. I'm concerned about reviewing the block that I've just conducted over the past week, 2 weeks, whatever it might be. Okay. And this helps actually, but why this helps, it helps me because I can like put a different hat on, if you like, and start to think of, hey, do you know what have I got from this? And I think that focus block, and you know you're going to be reviewing it, not only helps you stick to the rules and stick to the process, but also when it comes to review point, you could carve out some time. It doesn't take long. Carve out a bit of time the weekend after the market's closed or whatever it is. It's not molded into your execution and the trader's hat. It's like, hey, this is the head trader's analyst's hat who's looking at the trader's performance and suggesting tweaks and adjustments based on the performance of the block. So in trading, right, guys, we have so many hats on, right? Risk manager, you kind of head trader, you CEO of the trading business, you are the risk manager, all these type of things on. You're the analyst, you've got to search for trades, got to execute. So this just helps you kind of separate those things. Okay, so block win is, hey, outcome was good, trades worked well, I executed them as I expected, fine. Now, you look at that and you say, okay, do I want to do more? Do I want to do an additional block? Do I want to bring it now into my main trading kind of system? Do I want to add more size? You make a commercial decision from the outcome of the block. Now, if it's a block loss, you can say, okay, what happened there? Did I slip up because I wasn't trading as I should be? Did I not stick to the process? That's the first sort of test, if you like, filter. If the answer is yes to that, I didn't stick to the process, I didn't really conduct the experiment correctly, i.e., I missed a few fills, I jumped the gun, then that's a different issue and probably something to work on mentally. And actually, we're going to be addressing some of that next week. You say, okay, well, I just need, and also, what, this helps you stick to that. If you have a problem with discipline and focus and conducting the process that you've set out, this block method helps, risk block method helps, because you say, hey, all I need to do to hit my goal is to execute this 10 times. And it helps you go, just get to 10, just get to 10, just get to 10, piecemeal that down. And so if the block was a loser, you go, okay, the strategy is either ineffective or something's wrong there. And the sample size, and your pure quants are going to say, we can't have a sample size of 10. We're discretionary traders. We do what we want. Thank you very much. If you're going to back testing 20 years of data, be my guest. But you and I work in the now. We work in the now that says Donald Trump's done this and we've got a massive bid in the market and I know this, I'm going to do this, I'm going to buy dips. We are really aligned with the current conditions and the current market regime. That's what a good discretionary trader does. So a sample size of 10 is absolutely fine for you to say, hey, I was buying this opening dip or the open reversal retake trade, which seems to be playing out day after day after day. Hey, what happened when I had another clip on as we pushed up to the highs? What happened when I did this over 10? And you go back and you say, right, it worked well, put it in the block win. Okay, it didn't work well. What was it? Okay, well, I executed it correctly, but actually, look, here's what I'm not actually judging the regime correctly. I'm not getting the conditions correct, and actually I'm adding something into highs when really is not true momentum. Okay, so how do I adjust that? Do I add an additional filter that keeps me away from that chop and that rotational market, or do I change it completely? So it helps you again. You have the loss in front of you. You've got the 10 trades. You look at them and you say, right, what needs adjusting here? And you might go, you know what? It needs binning. This is rubbish. It doesn't work. I shouldn't be doing this. It's not effective in these conditions. Scrumple it up, kick it out. Another benefit of doing the risk block, after that period. You don't go on and on and on and on and on and go, well, I'll just adjust and I'll tweak and I'll drive it with my staring down the bonnet, making these adjustments, and I hope it works and adjusting all these dials. No. You scrap it, you move on, you put something else in its place. Or the block is mixed, you review for drift away from the execution style, the strategy, hesitancy, inconsistency. To be fair, that's probably because you could still win with that. You could have inconsistent execution, hesitancy, and all this type of stuff and still win. But generally speaking, it's probably going to go in the loss section. All right, so how do we structure these blocks, the risk blocks? Now, we really want to think of keeping a control. So it's the same setup, it's the same idea. It's an opening range breakout, it's a Wyckoff spring. You've got a defined level that pops below. What do you define as a wick? Wyckoff spring is when you dip below. What do they call it? What's the guy, the traders these days call it? Liquidity grab. Wyckoff Spring. Wyckoff was there first. Is Spring liquidity grab? Maybe you're trading that. Maybe you're trading the opening range breakout, the afternoon breakout, the VWAP magnet, whatever it might be, whatever you call your stuff. And so you have that strict structure. You keep to it, and then you review and adjust after the block. You don't get tempted by saying I'm going to tweak and adjust mid block because I'm just not it's not working very well and I can see my performance. You follow it through to the 10, commit, because you've done. Listen, we've all done this. We've all started out something new, something fresh. We've tried it out. We're all fired up and ready to go. We're like, got this list of stuff we're gonna do. You've cleared your desk out, man. You've painted your wall. You're ready to go. Bang! Your first 5 trades are awful. You're like, what the heck, man? I could have done better with a coin, and you give up on it. But actually, you stick to it. You do another 5, and then maybe it works out break even or slightly profitable. And you go, you know what? There's one adjustment I can make here, and it stands out like a sore thumb. You look at it, you go, damn it, if I just waited for that closer candle, or if I just did this, or if I just, that would change those results massively. But you wouldn't see that if you abandoned it after 5 trades, which is what most traders do. They take a trade, oh, it's a loser, oh, it's a loser. Oh my God, what do I do? I can't trade this opening range, bro. I can't do this. Just look, I've look at my equity curve, look at my week, it's awful. But actually, that maybe is, but you don't know for sure until you've risk blocked it. And 10 might be enough, not be enough. That's fine. You adjust it to suit you. But this is thinking structurally and long term and not looking for those short term hits. We're still short term thinkers, right? You're a day trader or you're a very active trader. So we still want to kind of be sitting here and going, well, I need 300 sample size before I make an adjustment. Mate, once a day, a year. I'm going to sit through drawdown for a year before I make a tweak. Absolutely not. No one wants to do that, right? So we've got to kind of find the balance with as discretionary traders and active traders of getting enough sample size in versus sitting there like idiots clicking away saying, well, I need the biggest sample size possible to make it effective. It's like, well, okay, technically, right, if you're doing something that really serious in a laboratory and you need this big sample size, I get it, I understand it, but we live in the real world here, and sometimes we've got to make decisions based on the data we've got, and often 10 trades is enough, 15 trades is enough, 5 trades is enough. And so it's judging that based on the type of trader you are and the flow you've got and the type of way you execute and all this type of stuff, and saying, you know what, I need to make an adjustment now. I can't just keep bashing away here when it's failing. Now you will know where their sweet spot is for you. Some people it's a little bit more, some people it's a little bit less. Maybe a bit more reactive to the day's regime, maybe you're less reactive to the day's regime, look at things on a higher time frame. That's fine. But don't get suckered into doing stuff just because that's supposedly the right way to do it. We know what the majority of the results of people, sorry, the results the majority are getting. So we think differently. So structuring risk by theme or trade flow. So we talked about if we structure it by setup or strategy, you might think of a theme. Like, okay, I'm going to take a trend continuation on these days, or maybe you trade crude oil. I'm only going to trade this, post inventory, a mean reversion type trade, or you trade cable and you want to trade it after NFP or FOMC on a breakout. So you can theme these up, and these might not actually give you a lot of trades very quickly. It might take a while, but again, you're being strategic and you're saying, hey, here's my block of trades here, and I've got another block of trades here, and I've got all these risk blocks out on your table. You can't see what I'm doing. I've got poker chips here. I've got my risk block here, my risk block here, my risk block here. And you get these and you line them out and you say, right, how's the performance? And you're adding them into each section. There's my CPI breakout and cable. There's my exhaustion scalp at the open. There's my mean reversion VWAP magnet trades. Right, I need to do one more of those. Okay, I've only done 3. I've got one today in there. And now you go, right, I've done my chunk. It's time to review that. And now you start to build all these playbooks and this framework that helps you think in the future, helps you not worry about the individual trade. And also don't forget, right, you might have, I don't know why I bought these out as props all of a sudden randomly here, but you might have different setups, right? So you've got one setup, 2 setups, you've got your blue and your black, okay? And you might be saying, you might get, an opening range breakout. Let's say opening range breakout is blue. It might be like loss, 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 loss. And it might be those things that come and you're worried about your whole trading because that's what's being triggered. Now, you may have multiple different playbooks, multiple different strategies, and you are judging your trading just because the blue strategy or the ORB has come out in sequence. Whereas this other strategy you might have not get it triggered yet. And actually, this is the more effective strategy. But you're judging your performance based on this strategy that isn't working very well. And so when you're chunking things out into risk blocks, you say to yourself, actually, I haven't even finished that risk block yet. I haven't got any of those CPI reversals or breakouts or whatever it might be. And then you can judge each individually. And just like if you were a franchise owner looking at the different businesses, you say, you know what, that one's not working. You're gone. I've analyzed this in the risk block. It needs to go out the door for now. It needs to be paused. These two are pretty effective. Let's keep these on. What's the next experiment? Let me risk block these into another group of 10. Let me up the size a little bit and let me see how they do. And that plays the part in the bigger picture in the equity curve, etc. I hope that makes sense. I know I'm using these as props, but I know you can't see half of this stuff, but hopefully it makes sense. Like thinking of these things in different chunks. Okay, and one of the other additional things here is it helps you deal with drawdowns. So real world, we all have drawdowns, we all have stagnations, we all have stuff that doesn't serve us, and we have challenges, right? This is the real trading world, right? No one's equity curve does that forever. You might have spells where you go bottom left to top right, very nice, but you're going to have times when you stagnate, you draw down, and often the drawdown is when you're stress tested the most. It's the time when you feel the most under pressure and you have to do something about it, because your brain's saying, I want that equity to be back at that number which I saw at highs. I felt good at that number. It was the highest it's been. It's my high watermark, and I want to feel good again about it. And so you have that psychological urgency, and that often plays out into trading. Now, the beautiful thing about thinking in terms of risk blocks is you can use them to rebuild your confidence. You can rebuild your process, and you can say to yourself, hey, listen, I don't want to fall into the trap of revenge trading, of oversizing, of all the things that we've all fallen into at some point in our trading journey. And maybe you're still kind of suffering from some of that now. It's okay. That's part of the journey. But maybe thinking in terms of risk blocks and saying, listen, do you know what? Here's a risk block that I'm going to call a recovery block. And I'm going to reduce the risk slightly on each trade. So I'm going to maybe use 0.25 R, my normal R unit, and I'm going to do this strategy, that strategy, and I'm going to focus on the process. And I know it's an overused term, I know it's a cliche, but that's how to tactically do it. You say, you know what, I'm in drawdown, I don't damn well like it, I don't like this, I'm not going to be one of these people who says, well, you shouldn't feel emotion about your trading. Nobody wants to be in drawdown. I don't care who you are, you feel bad about it, right? The difference is how you respond. So responding with, you know what, risk block in place. Let's run this for a week and see where we are. Let's not worry about the next trade. Let's not worry about the day. Let's just worry about executing this risk block, and then we'll review. And do you know what? Sometimes it shines a light on some of the stuff that's not working so well. Because when you're in the thick of it, you know this as well as I do, right? When you're in the thick of trading, you don't see things as clearly as you do when you're not. How many times have you taken a trade, later on the day, you've looked back and you've gone, what the hell did I take that trade? What am I doing, man? What exactly is that trade? You can't even justify it. I don't even know why I was doing that. In the cool, calm light of day, you don't do that. However, in the heat of the moment, you think it's the best thing ever. I've got to go on this trade. This trade's going to make me so much money. And so the beautiful thing about doing this is that you kind of chunking up these trades into risk blocks, and it allows you then to recover from drawdown slowly, not trying to get it all back in one go, which is what your brain's desperately saying, I'd love to get this all back tomorrow, let me get it all back now. But you know that the right thing is to get it back slowly, the process in place, recover that drawdown, get yourself back to equity curve highs. So it's a really good way of kind of rebuilding confidence, working out what's wrong with the strategy, your approach. Maybe, often I've seen this with traders, guys, is that it's a simple fix. Something like don't trade in the first 5 minutes. It sounds like the most crazy thing, but often I look at traders' performance and go, if you just sat out the first 5 minutes, that would halve those losers. Yeah, but I might miss this. Yeah, but how many have you actually taken? We flick back through the blotter and you go, you've caught one in the first 5 minutes over the past month that really worked in your favor. That was 4R. You've lost 84R trying to scalp the first 5 minutes, and it screwed you over. And you wouldn't see that unless you kind of chunked it up into those risk blocks. Okay, so how do we kind of log this stuff? Block ID, or the name of the block you're doing, make something up. Either this is the ORB risk block or the recovery block. The setup, if you group it by setup, number of trades you want to take in the block, the net outcome in terms of R. I'm always a big fan of thinking in terms of R units. I think you should too. I mentioned on a podcast earlier, Rashir is a great trader. He's a developing trader episode. He is a big fan of talking in R units, and that has enabled him. I've seen him scale up his account and his risk size dramatically because he's able to think in R units. So I've seen traders come up using that framework and working very well. So one thing is to absolutely really consider thinking in terms of R. It helps you not kind of think, oh, what's this worth? This R unit is worth, oh, it's worth this amount or that amount. It's very difficult to scale up at that point. Any notes on the risk block performance? Did you follow your plan? Was the edge there? What adjustments are going to make for the next block? And you know what? When you do it in the cold light of day, it's so much easier. Honestly, try it. Just try it. Do a risk block of trades in the cold light of day. You look at it and you'll go, I can see where the adjustment is. Just like, businesses hire consultants to come in because they're so close to it. They're so close to it. Or like traders hire coaches, right? Very often I'll come in and say, hey man, you're not, why are you doing this? This doesn't make sense. And they go, oh, actually, I don't know. Just like a business hires a consultant, because you're so in the thick of it, so myopic about what's going on. Someone coming in and going, I don't understand why you're opening that hour. I don't understand why you're offering that service, or why is it priced at that? That doesn't make sense. You go, you know what? I don't know why I'm doing that. And that's the thing with trading. As us traders, we get so focused on the execution that being able to operate these risk blocks and saying, you know what, I'm going to review these, allows you to leverage on that, whatever it is in your brain. I'm not a psychologist, that makes you look at things objectively and go, well, you know what, maybe I don't want to be trading the first 5 minutes. Or you know what, why do I keep trading gold on the short side when actually, obviously here, all the shorts have been getting nailed because we've been an uptrend, and the odd day that I've caught one is, you get the idea, right? Okay, so the psychology is it helps you build trust in your process. We talked about that. Disconnects the short-term emotion from long-term logic. Super important, that one. Improving that mental clarity around losing streaks and hot streaks. I didn't really mention that, did I? But, we are traders and we sometimes have egos. When we have a hot streak, we think we are the best thing since sliced bread. We think we're a trading god. Look at this. If I extrapolate this out, watch out, everybody. Warren Buffett, better step aside. Look at me. If I extrapolate this week's performance out over the year, heck, let's do it on 10 years. Get the spreadsheet out, right? We've all fallen into that trap at some point, right? It helps you go, well, the risk block did well. I've got others on the go. There's more to do. And it just helps put things into perspective a bit more, both on the positive and negative side. Okay, so common mistakes in the risk block. Of course, changing plans mid-block. The whole point of the block is I'm going to risk this amount of money. I'm going to do this amount of setups, whatever it is. If it's a risk block, it's going to be, hey, it's my 10-hour risk. If it's a setup block, etc. Assigning risk per trade without seeing the bigger risk picture. So this might be when you go, okay, I'm going to risk. It's perhaps a bit slightly off piste here, but hey, you know what? This is all stuff to try and help move the needle. You might say my risk block is 5R, right? Right, so here's my 5R. I'm allowed to allocate that as I see fit over the next 10 trades. Now, you may say to yourself, actually, I'm prepared to risk 3R on this trade because I believe it's a grade A trade. Now, I know it's a controversial issue. Some people don't like dynamic risk sizing. Some people prefer to use static risk sizing. Let's not get into that now, but that's something you can also do. Say, here's my risk block allocation, and I'm allowed to adjust dynamically based on the what I believe is the quality of the setup. And so assigning risk per trade without seeing the bigger risk picture is you get all fired up by one trade and not actually step back and say, hang on a second, I've only got 5 units of risk here. If I risk 3 on this, we're in week 1, dude. What are you doing? This is the first thing you've seen. Why don't you take it steady? And judging a strategy too quickly based on one outcome. That just blends in with what we talked about when you're looking at each individual trade. One trade, reactive, high pressure, emotionally loaded. Risk block, you're more structured, you're strategic, you're focused on the process. This may be an unlock for you if you struggle with the the butterflies. That's the one. The butterflies, the anxiety, the pressure before the bell, the pressure before CPI, the pressure before while you're holding a trade. This might just unlock it. This might be like, you know what? Same strategy, same approach, everything's the same, but I just think in terms of risk blocks. And that might just help you really think a little bit clearer about stuff. So when can you use these? We talked about this. If you're testing a new setup, it's a great way to put it in a sandbox, if you like. I'm going to risk X amount of money on this. So our unit is going to be X. Fine, that's what I'm going to do. When we have different regime shifts, so market kind of revolving around headlines, the current regime versus the one before, which was worrying about who was going to be coming into the White House, versus the one before. What I can't remember where we were back then. Where were we? COVID, maybe that's maybe one too many. Inflation, you get the idea, right? So you might want to adjust it and say, hey, I'm going to use these. Maybe use it under normal conditions. Maybe use it after a drawdown. Maybe use it during kind of known risk events. And you say, hey, you know what? I'm just going to stick to this defined risk. So group trades is the framework for you. Group trades into defined sequences. Thumbs up's come there. Set your block risk level. Execute as cleanly as you possibly can. You're a human being. You'll make errors. Review, adjust, adapt, refine. There's your block. I'm going to do this for a set period of time. Here's my risk. Here's the setup. That's risk block alpha. Risk block delta is this, where I'm going to trade this setup, this risk, this period of time. There's gamma, whatever you call it, right? Making stuff up on the fly. The point is, there's your risk blocks, and so now you're operating on a higher level. You're operating from the CEO perspective rather than the front line. And I understand it's difficult because you need to be in the trenches still to see the nuances, to see the tape, to see all the stuff that matters for the execution. But this helps you with the bigger picture thinking. And also something visual. I use poker chips, but whatever it might be for you, something visual. So you say, this is 1 of 10. It's not a big deal. This I've got 9 more kind of allocations of this. Doesn't matter. This one's going against me as soon as I pull the trigger because it's going to happen. Okay, fine. That goes there. I'm going to review that. I don't need to worry about over reviewing it now. You may need to journal some stuff and write down your feelings and stuff that you want to, but you're not going to go into the weeds until you've done the full 10, and then you go, actually, you know what? Let's look at that opening range breakout I took on DAX because I've done my 10. I need to review it now. Performance, etc., etc. So some things that you can potentially do if you like this and this kind of floats your boat and maybe resonates with you in some way. Build your 10 trade risk block, 5 trade risk block, come up with ideas, set the outcome, the goal, the edge is going to be, have clarity in the execution, the setup, etc., and then review it as a sequence. Don't worry about the individual score. Okay, so it was something a bit different this evening. I hope that made some sense. If you have any questions, ladies and gents, please feel free. No question is silly. I know I've rushed through some stuff sometimes. If you want me to clarify something a little bit better, I'm more than happy to do that. We were back again next Tuesday. Where are we? 27th. So we are going to be. We should be back. I'm looking at my phone here. Back on the 3rd, and the 10th, and the 17th, and 24th with another theme, which I think will help you kick things up a notch. Let's just have a look and see. Let me go back this slide here. Victor says good structure for management. Thank you, Mark. Yes, you know what, Victor, this is different, right? Sometimes I come up with these things. I think, is this people going to enjoy it? But I know that you guys, the ones who come on these webinars regularly, if you're not, maybe you will become a regular. You ask the right questions. I think you think similar to me about trading, and you want to think differently. And sometimes you might look at this and go, not for me. That one's not for me. And that's fine. But later on down the line, you're trading, you might say, do you know what? I might try that risk block. I might think about managing my trades a little bit more effectively or a little bit more differently because I'm struggling to overcome this hurdle, or I'm struggling with this drawdown. It's really bugging me. I'm struggling to get above a specific equity level in my account, etc., etc. And you sometimes feel a bit flustered and like I've tried everything. And you go, you know what? I remember that guy talking about risk. Okay, I'm going to try that. Okay. Robin says, hi Mark, loving this one too. Thanks so much. How do you define the ideal size of a risk block? Is it better to fix it by number of trades, time period, or signal type? I think number of trades, Robin. So number of trades. So I say, okay, and again, it depends on the frequency of how often you'll see this setup. If you're trading something every day, maybe you want to trade it for kind of 10 or 15. If something occurs once a week, you might want to reduce it down so that you actually, because here's the problem, Robin and others, is, and I see this loads, is traders will sit in the demo or sit on small size going, I just want to test it, see if it works a little bit longer. And then as soon as they're comfortable with the damn thing, they go in with the bigger size, or they go in with the normal size, and the regime of the market shifted. And so that's no longer effective. And so they're constantly behind the curve. So I'm always a one of acting now, going now, and face the consequences of perhaps not having enough data. So you asked me a similar question you asked me, but size of the block, yeah. Size of the block, 10, I think, is a good way of doing stuff. It's not so much, because it is the thing, if you have too big of a block, you end up thinking, well, so far ahead, I don't care. So it's got to be short enough that you're worried about the impact of one, because if one messes up, if you're taking 10, that's, that if you don't do it correctly, that's going to pollute the results. At the same time, I don't think you want 50 odd, because you're like, who cares about, you're less worried about the process. So find that sweet spot for you. So I think it's better to fix a number of trades. Time period or signal type. I don't think you need a time period. You could put a choke on that and say, listen, at the end of the day, after this period of time, I'm going to stop doing the risk block. But I think it's better to do it by number of trades, because you can actually see then you've got that data. Okay. Hello, Sue. Sue says, great class. Thank you, Sue. Appreciate your support, Sue. You're here regularly, and you send me some good feedback, and so thank you for that. How many risk blocks do you run at once typically? Any suggestions on that? It's a good question, very good question. I don't like to overwhelm myself. Like, I'll say to myself, okay, listen, and the thing is, I think, is once you start to think in this framework, it doesn't overwhelm you, but at the beginning it can, because you're like, well, it's a danger of overcomplicating stuff. You're like, I've got this risk block for this setup, and I've got this risk block for as a catch-all risk block for number of trades, which involves this setup and this setup, and you can overcomplicate things. I think the best lens to look at this through, Sue, is to say, okay, what do I absolutely have to get better at in my trading? What is the non-negotiable? It's the biggest barrier at the moment. It's the biggest domino that once I topple that over, others will follow. Maybe it's risk management. Maybe it's this, maybe it's that. And so you focus your risk block on that, and you say, actually, it's running my trades. I need to run my trades. I'm second guessing. I'm getting seduced by unrealized P&L. No. I'm not doing that anymore. So you come up with a risk block profile that says, I'm going to set my target, and each of these trades that match this criteria, there might be some, A to B trades you don't want to run, but each of these trades that match my criteria, I'm going to run these for the next 10 trades to the target. The risk is going to be X. And so that then aligns with what you're trying to do, and you're trying to achieve as a trader. I'm trying to get, in that example, I'm trying to get better at running my trades. And so, even though it might not necessarily be, might not change things too much, it helps you, again, not think too short term, and help you think longer term and go, hey, I didn't run that trade. That's fine. Let me start again. What did I do wrong there? Do I need to adjust it? I just want to get 10 trades under my belt with this risk block of 10R when I'm running them. And so that at the end of it, I can look at and observe. And it helps the goal become more meaningful, achievable, not so far away that it seems pie in the sky, and not so close that you're worried about each individual tick affecting the outcome of that trade. That's a good question. Okay, so do you think percentage risk or dollar risk is okay? Anthony, oh, sorry, I missed the question. I'll answer this, Anthony. Percentage risk or dollar risk? I think dollar risk is the best way to do stuff. Listen, we're traders, right? We use again, this is my framework on stuff. You should think about money in the way that benefits you the best. But I think traders should think of capital as a tool. We can get some obscene percentage returns, just purely because of the way that we super high risk. We're risking this. We're hoping to get 2R from this. And we're trying to get this trade. We might get 4 trades. And all of a sudden the percentages look really obscene. But that's because we're taking more risk. There's not many people who are investors who say, "Hey, I got 10 million quid. I'm going to stick it all in and try and make 10R on the trade. And if I lose, I'm going to lose 10 million." They chunk it up and say, "Well, I'm trying to make 15% a year on that, and my maximum drawdown is X." So I think personally, I like to think of stuff in terms of dollars, and then convert that, or pounds, and then convert that to R units. So what's my R unit for trade? So I might have a standard R unit. So your standard R unit might be, let's just use an example, easy maths, because public maths is never good, even though we're traders. It says $1,000, right? £1,000. You might say that's my R unit. Okay, and on some certain trades I can risk half R, certain trades I can risk 2R. Okay, and now your risk unit becomes, or your risk block becomes, your risk unit is 1R, which you know to be £1,000, and now a risk block might be 10R, which you know is £10,000, and it just helps you disconnect, I think, a little bit. Okay, I missed your. Thank you, Anthony. I missed your question, Gary. The idea of a group of 10 or more trades makes perfect sense. Thanks for the session. Appreciate your feedback, Gary. And yes, you know what? Even if you kind of simplify all of this and you say, some of that's a little bit complicated, or I don't want to, get down that rabbit hole, and that's fine. Absolutely, I understand. Sometimes you go, I feel like I'm dialed in. I feel like I'm nearly there. I don't want to mess things up. Nearly went and got Pepperstone back. Don't want to mess things up, right? And so the way to simplify this is to say, I'm going to do the Scottish John method, which is I'm going to do 10 trades. I'm going to do 10 trades with 10R, and I'm going to kind of just think about it in terms of a chunk of 10. I'm not going to worry about the outcome. If worrying about the outcome of an individual trade is the kind of constraint in your trading, then it might be just simplifying stuff and saying, you know what, I'm not going to risk block by setup. I'm not going to risk block by theme. I'm not going to risk block by regime. I'll save that. For now, I'm just going to chunk stuff into doing just 10 trades at a time and thinking in terms of a risk block of 10. I know what my 10R risk is, and so it helps me not overthink about individual trades. That might be the perfect process for you, or anyone else who's listening to this. Alex says, what's your process when a block ends in a drawdown? Do you lower risk for the next block or keep it constant to preserve sample integrity? That's a great question, Alex. And do you know what? I don't think how I do this is correct. You've got to make a judgment. We are discretionary traders, right? And this is such a flaky answer. I know it is, mate. But you've got to look at the market and say, hang on a second. Like, I did what I said I was going to do, but the market just did nothing. Let's say, for example, let's say take the ORB, right? It's a volatility expansion type trade. You want to take it kind of systematically for whatever reason. You take it, you have your risk block of that. I'm going to take 10 ORB trades, and it'll take me a week, and I'll do one of the European Open, I'll do one of the US Open. And you look at the data and you go, man, that absolutely sucked. But then you look at the chart and you say, well, the daily's been doing nothing. We've been in this range. And so at that point, what do you do? Do you say, well, I'm gonna kind of lower the risk, I'm gonna throw it out the window? You probably don't. You probably look at it objectively and say the conditions weren't quite right. Or vice versa, you look at it and go, you know what, that was the perfect scenario for it. It didn't work. What am I doing wrong? Do I need to adjust the entry criteria on this? And I think that you don't go too big with if you're okay. Here's probably how the framework of thinking of this. If you're using a risk block purely from a perspective of I'm just trying to limit the attachment to each individual trade versus I'm experimenting with a strategy, or I'm adjusting a strategy, or I'm trying to develop this strategy more, I think that's two separate ways of thinking. Why? Because I think that if you're in experimentation mode, you might kind of go a little bit reduced size and expect that you've got to do a couple of runs before you get it right. Now, again, it's a balance between striking while the iron's hot. If a trade is working well and in the right conditions, personally, I'm a big fan of just putting your foot on the throttle. But that comes, I appreciate that comes a little bit more with experience. But you decide whether this is kind of experimentational risk block or a purely psychological one. And so if you were saying, okay, that block has ended in drawdown and it's an experimental block, you might say, well, actually, I'll try it again, but I'll keep the risk the same, or I will knock it down a clip. I think that's fine. I think that as long as you're not overcompensating for out of fear. How do I say this without sounding stupid? I think there's often here. I think is how it sits, right? Often traders act out of fear, and I'm not saying you're doing this, Alex, but often as traders we can default to fear. I'm going to reduce the size, reduce the size, reduce the size. There's nothing wrong with that, and we absolutely should manage the risk. But you're here for a reason. And at some point, you have to say, I'm prepared to risk this because I want a chance of making that. And that's the name of the game, right? And so at some point, you've got to go, yeah, if I keep reducing the size on this, if it works out and think optimistically, what's really going to happen? I've now got to up my size again and again and again, and hope this continues on and on and on. While up my size for me to get to anywhere meaningful. And so I appreciate it's very personal here, but you make a decision based on what you're trying to achieve. Hey, do I want this to work now? Do I believe it's going to work now? In which case, there's no need to reduce the size. I just need to make an adjustment, go again. Or it's an experiment. It's part of this. I'm not worried about this position size too much. I'm not worried about the P&L outcome. You keep the size low. Okay. Cheers, Eddie, my man. Another great one. Thanks, Mark. You're doing very, very good at the moment. I know. Mark, great as usual. Thank you, Rob. Appreciate that. By the way, when I read these, I read them and realize what they say as I read them. So even though it seems like I'm massaging my own ego here, I'm genuinely not. I'm going through and I'm reading them, and I want to shout out people who show their appreciation too. Um, Robin says, Robin Solar says, how do you recommend managing emotional reactions within a block, especially when the first few trades go red? Any specific routines or mental resets? I'm going to do a real deep dive on that, Robin. I've got that planned actually for the next one or the week after, but that's a really good question, mate. And that's the whole point we do these blocks, right? I think it helps to really visualize and think, I'm doing a block. I'm doing a block of 10. So I'm trying to disconnect from the outcome and the emotion and the P&L, everything that's felt with that individual trade. And if you can, and listen, first time you do it, it's going to be exactly the same as the other times. The next time you do it, you'll feel a little bit better. And you'll say, hey, you know what? I got to the block, I got to trade 8, and then I threw it out the window because I got emotional. I trade on tilt, blah, blah. But the next time you do it, you go, hey, I've done 8 good trades with the process. I've got 2 more to do. And so I think that, when you're within that block and you do get tested, because you will, you've got to remind yourself, hey, I said I'll do this. This might be the one thing that's holding me back to get to where I want to be. All I've got to do is get to the 10. I'm not going to do this for a year. I'm not going to do this forever. I'm going to do this for 10. And it kind of soothes that internal voice. And then I'll review. And when I review, I can make any adjustments I want. But you have to kind of talk yourself down off the ledge in the heat of the moment, because that's obviously the thing you've mentioned. It's the thing that's not serving you. It's the thing that's, those emotional reactions are probably what's causing you to trade irrationally, out of frustration, trade on tilt, etc. And so really putting into perspective and saying, the reason I'm doing this risk block is to give me the superpower to be able to trade and not worry about the outcome of the individual trade. And so I'm going to be tested, so I must pass the test. I'm going to be anxious. I'm going to have stress. I'm going to be frustrated. I'm going to want with every fiber in my being to take the next trade with quadruple size and dive in on this momentum move because I just want to make this money quickly. But that's the point. You go, no, I'm here to do this for a reason. My objective is to do 10 trades in this risk block. I will not concede. I will not be seduced by the lure of quick money and the gambling mentality. I'm here to do a job, and my job is this. And it sounds very simplistic, but that's the framework to have as a trader, and to think, hey, if I want to do this properly, I need to step up, and I'm going to be tested. It's going to sting. But also, here's the thing, Robin, and others, is, when you are in that position, you can't lose, because if you're tested, good, because the more you're tested with this stress, the more you're stress tested, the more you have the desire. I've been stopped out the lows and now it's ripped and I desperately want to get in at highs and I want to get my money back. And you go, no, my objective is to stick to the process. I've got 9 more blocks to do. Stop. The more you do that, the more resilient you become. And so you put yourself in a really win-win scenario. Okay, well, even if I lose money on this, as long as you're accepting the risk, I still win mentally because I've been tested, I've been stress tested, and I've passed it, because actually objective wasn't to do well for an equity curve perspective. It was to do well from a planning and a process perspective and do those 10 trades. And that then gives you confidence, which then ultimately will support the P&L at a later date. Rob, another Rob says, I missed last week's webinar. How do I get a recording of it, please? That should come out to you, Rob. If it doesn't, I know there's some things with GoToWebinar. Sometimes it doesn't get sent out. Sometimes it goes to junk. And we're trying to, Pepperstone, working hard to sort this out. If you're on my daily email list, Rob, if you go to tradersmastermind.com, you can sign up for that. Reply to that, and Armand, the guy who deals with my inbox, he's a good guy. He will sort out a recording for you if it's available. sometimes it takes time to get going and stuff. But it'll send you all the ones we've got that we can, or link to those. Okay. Sunrise says, thanks for the day, Mark. I was just going through your podcast. Amazing interviews. Appreciate that, pal. Slightly off topic. Do you manage to read Al Brooks' books? There's a tongue twister for you. If so, can you comment on your observations? Please ignore question if it's well off topic. No, I won't ignore any question, pal. Trading, I will talk about trading forever. I love trading. Lucky enough to have found my the thing that really kind of floats my boat in my early 20s. So, hey, have I read Al Brooks' books? I've got it. Is it up there? Is it there? There it is, yeah. Trading. Have I read it all? No, I haven't. I'm honest with you, mate. And I'm not saying it's not good, but some people have read it and really enjoyed it. It's not quite my thing. And don't forget, I come from a different angle here. That I've got some reasonable experience, and I kind of some stuff isn't as relevant. And I'm not knocking his book, and it's not an ego thing. It's like, but sometimes I'm like, okay, is my time well spent reading this? And it's good material. It's thick material. It's a bit heavy in places. And for me, it's like, no, it's probably not. So I've skimmed through some of his bits. So I've not read all of Al Brooks's books, no. But the feedback's been good from me, even though at times I know people say it's quite tough going. Um, Al Brooks is a good guy, I think. One thing I'll say about Al Brooks is um, it's a very unique style, and so are many traders actually. Tom Hoogar's unique style. So just be sure that that style is for you before you dig down the rabbit hole. Nothing against Al. He came on the podcast, had a great conversation with the guy, very cordial, had some email exchanges. Absolutely nothing. Great guy, right? But he's got a unique style, and I know it doesn't suit everybody. So just be sure, same with anybody, is that the style and the stuff that they say resonates with you, because it can really cause a kind of friction in your brain. You're like, well, Al Brooks says this, but I see this. It's like, well, sure, maybe Al Brooks is further on and he's got more experience, and maybe it works for him. But your job as a trader is to carve out something that works very well um, for you. Ibrahim says, I can't see the slide. Am I the only one? Hopefully, you're the well. Not hopefully. I'm sad that you can't see the slide, but I hope everyone else is seeing it. I would have. I think it's probably just you, pal. I'm not really sure what the setting could be. Sorry about that. Maybe if you get the recording, you'll see the video as well. Nuno says, thanks, Mark. I like the poker chips becomes visual. The concept really helps me in other ways, like discipline psychology and what Victor mentioned, trade management. It's an all-rounder. I love the concept. Yeah, you know what? I kind of glossed on this because they happen to be on my trading desk as we're talking. I think they're really good ways to think about things, like the risk block method, your R units risk. Maybe you've got a chip that's got 100 on it, which is like 1R unit, so you can split it up then into 50. So if your 1R unit's £1,000, as we said before, you might say, okay, there's my 1R. 100 is 1R. But sometimes it happens when you make half an R, or you want to risk half an R. So you might have some 50s, you might have some 25s for quarter R. So it's like 100% of the R unit, 50% of the R unit, and if you want to use 25% of the R unit, or then you get 200 for 200% of the R unit. That way you can say, okay, my trading day, I'm risking 4R. So there's my four units. Okay, this trade, I want to risk 2.5R on this because I think it's a grade A setup. This trade's just a normal R, and it helps. You do with it what you see fit, but you're like me. I think it's quite nice to have a visual representation of stuff, and plus it's nice to fill around with. All right. Do you track metrics like MAE or win rate volatility within each block to catch early signs of performance shifts? That's a good question, Alex. I think if maximum adverse excursion is important to what your objective is, i.e., that's probably going to be important for your closing too early, holding trades longer, that type of stuff. It might be that you track MAE, but you also track what happens 15 minutes after the trade. So if you have a problem of closing trades too early, but MAE maybe it's kind of too late because the trade goes in your favor, comes back, then one way of doing it is to track the trade performance after you close a trade, and you say, hang on a second, 15 minutes, 5 minutes, an hour, whatever time frame you're on, this was the position, or this was the MAE in the 15 minutes after. Excuse me, that can give you a very good idea of, hey, I'm closing trades too soon, I'm leaving too much money on the table. So it depends on what you're trying to do. I think it's a good thing to track, but it depends on the objective of the risk block. If the objective of the risk block is just to get your thinking away from individual trades, then maybe you don't need to. But if it's involved in, hey, I'm closing too early, or I'm leaving money on the table, then absolutely track the metrics that matter for you with that risk block in point. And by the way, that's a really good question and something I maybe didn't mention. I think each risk block should have an objective. Your objective is singular with the risk block. I'm trying to do X. I'm trying to think, I'm trying to think in terms of 10 R's in a row, or I'm trying to, that's the objective of the risk block. And that way it doesn't overcomplicate things, stuff. Ibrahim says, anyone here? We're here, buddy. We're here, pal. Robin says, do you ever modify your edge or execution mid-block, or is that strictly reserved for post-block reviews? Yeah, post-block, Robin. That's the You don't want to. Now, listen. I could say, oh, you can make minor adjustments and give yourself a little bit of leeway, and here's the stuff that you can do mid-block. But that's kind of ruins the whole objective. The objective is you trade within that block, and then you make the review and adjustment. And actually, it helps you get into the habit of, I need some sample here. I need to do this before I even decide whether it's a win or a loss. And think about, a business perspective, right? If you're opening a new branch somewhere or offering a new line in your store of, you're selling shoes or dresses or sweets or whatever it is, you might be like, okay, I think that's going to work, but you wouldn't go after day one. Hey, how many of those shoes did we sell? Well, we sold 2. Well, get rid of them. You're not going to. You're going to like, well, let's run it for a couple of quarters and let's see how performance is before you review it. So it's the same type of thinking. Rob says, thank you, appreciate that, pal. Alex says, for advanced traders already using block logic, what's one refinement or habit you think adds the most consistency? Oh, question. So the most consistency in terms of executing your process, or maybe in terms of the P&L? I'm going to answer. I'll answer a couple of those. So I think you might be asking, adds the most consistency. If you're asking consistency in execution, then it's really being comfortable and clear about what you're doing. So when I see this, I'll do this. Why you're doing it, because the logic brain always, or the chimp, if you like, always comes up with an argument. I shouldn't be doing this, shouldn't be doing this, shouldn't be doing this. So a logical reason. I buy momentum ignition because I believe that actually that's the start of a volatility expansion. And with volatility expansion, I believe are much likely to run to the ADR on the day. You kind of have a logical reason that helps you click the button when you say you're going to. And then just putting it in terms of what's the worst that can happen. It's like, just do what you say you're going to do, because if you don't act with consistency, there's never any real data to work on, and you're always sitting there spinning the wheels, spinning the wheels, spinning the wheels. If the question was really based on consistency in trades, then, Jill, I think the biggest thing is just to be aligned with the regime you're in, and remember that the higher time frame rules all. I mean, I know people are, oh, trading in 1 minute doesn't really apply, but if you just kind of align with the one direction the market was going in, it can be very forgiving. If you're aligned with the longs, okay, some days you're going to get caught, but if you're in a massive uptrend, that's generally going to work out for you. Loads of other stuff that goes into that, but that's maybe a good summary with the time we've got. Okay, thanks for that. Sonia says, thanks for that, Mark. Appreciate that, pal. Robin says, how do you separate underperformance due to variance versus genuine edge decay when reviewing a block? That's a great trade. Again, I like to look at this from a purely discretionary trader perspective and use a bit of intuition, because you never know, man. And people always say, oh yeah, but when's the point you stop using a strategy and stuff? And I don't think there's a good answer. Some people say, oh, you definitely do it after this. I think you look at the bigger picture, Robin. If you're experienced in the markets, you say, listen, this trade should work out, right? I'm buying at lows. I'm finding that mean reversion, extension, rotation off the VWAP at lows, and the market's closing higher. I'm just getting nicked out. Something's just, versus, well, I'm selling into lows and it's reversing, right? I'm using two kind of really different examples. You might look at that and go, yeah, that strategy that says sell into fresh lows after the first hour low, it's not working, right? And that's not variance. That's underperforming because it's just a crap strategy. And sometimes you just know, like, hey, I'm not using the right tool for the job here. Other times you go, hey, that block's lost, but I've been buying those rotations to lows. I actually just think I need some more data. I think that's good. I think it's solid. I don't want to make any adjustments to it. Or maybe you go, I'll make a slight adjustment on the execution. I'll wait for that kind of pop to start before I get in. As I'm getting pinged, I'll widen the stop a bit. I'll make a minor adjustment. But theoretically, and again, there's no science, it's not perfect. But theoretically, Robin, you say, you know what? That should work well. That is something that should work well in the environment. Actually, when I look back, that's going to be working super well. It's just something wrong there. And maybe it is just the variance. Maybe your expectancy is like, hey, you know what, I lost, but actually, you know what, 8 of those I lost, 2 of those I got a good target. It made me about break even, but a slightly different condition, slightly different that would come out with a 10R winner over the 10R, over the 10 blocks or whatever it might be. And so I know it's a bit of a flaky answer, pal. I appreciate that, but this is the gray area of trading, of saying, okay, this should be making money. And often that's just going back and looking at the week and going, what did the week do? What did the day do? What was I doing? Well, you're an idiot, mate. You were shorting into this kind of strong market conditions. Every time you saw weakness, you were selling momentum and it was going a little bit low and popping back. Well, of course you're going to be wrong. Okay, versus actually, you know what? I'm buying these breakouts, blah, blah. And so it's aligning with the conditions and looking back kind of with a logical brain and saying, well, should this have worked? Well, actually, you probably should. It's just some minor tweaks and adjustments. That's a good question. Okay. I think that's it, guys. Have I got it for everybody? I think so. Yeah. All right. We'll call it an evening there, ladies and gents. Thank you so much. We're back again next week with a brand new theme for June. We only have a few days left of the month, so keep the risk managed, keep your eyes on the prize. If the month hasn't been so good for you, let's not be shooting for the stars just yet. Put June into perspective, think like slightly longer and say, you know what, maybe May's been a write-off for you. Fine. Don't try and salvage it. Say, you know what, June, I'm going to put this new plan into place, process focused, etc. If May's been great for you, then keep it great. Just keep doing the process and keeping the risk managed, thinking in the correct manner, process, risk, all the stuff. Do I really want to take the trade? Not over trading. All the stuff we know that's sometimes overwhelming, but keep us on track. All right, ladies and gents, we shall take care, keep the risk managed, and we'll call it a day there. That's what I meant to say. See you next one, guys. Thank you for your questions. I really appreciate it. Bye bye.